The bell rings on Wall Street, but no one's cheering. Screens glow green for a second, then freeze, half the tickers showing halted. In Beijing, state broadcasters break in mid-sentence. Trade corridors suspended. Soy cargoes vanish from tracking maps, and Treasury traders in New York watch the dollar's yield curve invert in real time. The room goes silent. Because this isn't another tariff scuffle. It's the moment America's financial shield buckles, and the only lever left is the one Powell swore he'd never pull again. Unlimited money. Within hours, commodity desks mapped the immediate consequence. China's promise to buy at least 12 million metric tons of U.S. soybeans in the final 2 months of 2025 and at least 25 million tons in each of the following 3 years. A scale designed to stabilize Midwest basis levels, but still framed as an extension of an uneasy truce, rather than a structural tie. Those purchase figures appeared in the same White House fact set cited by Reuters. Grain traders noticed the irony buried in that announcement. Just days earlier, China had imported 0 U.S. soybeans in September for the first time since 2018, relying heavily on Brazil and Argentina during the heart of the U.S. harvest window, Reuters noted on October 19th. That disruption underscored how quickly procurement can pivot away from Gulf and Pacific Northwest loadouts when policy risk flares. The pricing channel responded in textbook fashion. As soon as talk of tariff relief surfaced, Chinese crushers stepped back into the spot market, but they still reached first for Brazilian cargoes as those became cheaper relative to U.S. Gulf offers, Reuters wrote on November 3rd, citing traders who saw an immediate shift in booking patterns once FOB spreads and perceived policy risk flipped. Behind the soybean headlines sat the rare earth clause that markets read as the real leverage point. Beijing agreed to pause for 1 year the tighter export licensing it had introduced in October for rare earth minerals and magnets, while the U.S. offered a parallel 1-year pause on an expanded Commerce Department blacklist that would have swept in thousands of Chinese subsidiaries via a 50% ownership trigger, Reuters detailed in its Busan explainer. That U.S. pause effectively puts on hold a rule unveiled September 29th that would have required licenses, often denials, for exports to affiliates at least 50% owned by already listed firms, a change Reuters described as a major expansion that Beijing opposed. The delay, reported October 30th, signals tactical de-escalation in exchange controls even as both capitals prepare for longer-run competition. Investors in strategic metals equities had already been trading the direction of travel. Earlier in October, as China tightened license scrutiny, shares of rare earth miners rallied while analysts reminded clients that China produces more than 90% of the world's processed rare earths and magnets. The United States, by contrast, operates one primary rare earth mine and remains dependent on Chinese refining for the highest value inputs, Reuters wrote. Institutional datasets reinforce that concentration. The International Energy Agency's 2024 breakdown showed China's share of rare earth permanent magnet output above 9/10 of global supply, reflecting not just ore but the refining, alloying, and sintering steps required by EV drivetrains, wind turbines, and precision motors. The IEA, updated October 6th, presented these shares as part of its materials security dashboard. Customs signals inside China point in the same direction. Shipments of rare earth magnets slipped 6.1% in September from August after 3 months of gains, and broader rare earth exports fell 31% that month as new licensing practices took hold, Reuters reported in mid-October, a reminder that policy adjustments can pull volumes forward or freeze them outright. The soybean component of the Busan deal landed against a shifting baseline in global origination. Brazil has cemented its position as China's dominant supplier, providing nearly 80% of Brazil's total soybean exports, with 93% of September shipments flowing to China, according to ANAC data cited by Reuters on October 8th. That demand concentration gives Chinese crushers leverage over seasonal spreads and freight choices. Cost structure matters as much as policy. Reuters noted in January that favorable weather and a weaker real lowered Brazilian production costs and kept Brazilian offers competitive into 2025, encouraging Chinese buyers to maintain high draw from northern ports even as U.S. harvest arrived. Those conditions persisted into the spring, according to traders quoted by Reuters. Supply expectations reinforce that path dependence. Brazil's crop agency CONAB projected record soybean acreage and output into the 2025-2026 season, with production seen near the high 170 million ton range in a late October outlook, while USDA field analysts described record national output prospects in March despite regional variability. Those institutional projections shape forward curve behavior and crush margins. Producers face a different constraint set. USDA's Economic Research Service put 2025 farm sector production expenses at about $467.4 billion, modestly above 2024 in nominal terms, and essentially flat in real 2025 dollars, but still elevated relative to the 2004 to 2023 average, according to September ERS tables and May charts of note. Cash flow resilience this year rests partly on projected increases in net cash farm income and government payments, rather than broad-based declines in input costs. Labor market data at home informed Washington's calibration. The Bureau of Labor Statistics reported that people unemployed 27 weeks or longer accounted for 25.7% of all unemployed in August, the highest share since early 2022, with roughly 1.9 million in that category, an indicator of softening job-finding prospects. BLS published the breakdown in September. Macro policy signaled its own turn. On October 29th, the Federal Reserve cut the federal funds rate by a quarter point to a 3.75 to 4.00% range and said it would end balance sheet runoff for treasuries on December 1st. Bloomberg and Reuters reported, with Chair Jerome Powell cautioning that another move in December was, quote, far from certain. The Fed will reinvest all maturing treasuries and redirect MBS principal into bills while continuing to allow up to $35 billion in MBS to passively roll, a configuration aimed at easing funding strains without promising outright asset purchases. Powell's language reflected pressures visible in money markets and the labor data. Reuters linked the balance sheet shift to rising usage of the standing repo facility and declining bank reserves, arguing that the central bank was prioritizing market functioning within a still restrictive stance. That signal landed as corporate issuers weighed year-end funding needs under higher real rates. Busan's maritime clause added another moving part. The administration agreed to pause for 1 year new port fees on Chinese-linked vessels, fees that took effect on October 14th alongside 100% tariffs on certain cranes, while China committed to remove its retaliatory port measures, according to the November 1st White House summary relayed by Reuters. Freight forwarders translated that as near-term relief on specific lanes without broader certainty on container rates. Tariff architecture remains the larger wedge. Reuters summarized the package as cutting parts of the layered duty stack. Legacy Section 301 rates plus the newer across-the-board tariff by roughly 10 percentage points, with fentanyl-related categories singled out for halving to 10%. The scope of that relief still leaves an average applied rate far above pre-2018 norms, a level that shapes consumer prices and corporate sourcing models. On the Chinese side, the 1-year pause on added rare earth restrictions does not erase the underlying exposure. Those asymmetries explain why stockpiling emerged as the near-term hedge in both capitals. With U.S. export control expansion paused for a year and China's tighter license regime on hold for a year, firms on each side have a window to build inventories of critical inputs and legacy chips, Reuters wrote, pointing to the Commerce Department's delayed affiliates rule and the explicit general license pathway Beijing agreed to issue for several strategic materials. Inventory buffers are not strategy, but they are time. The soybean quota, however large, still competes with Brazil's scale. Reuters' commodity desk showed China capturing nearly 80% of Brazil's export program and maintaining a dominant share of September sailings, while CONAB and USDA documents seeded expectations for another expansive Brazilian harvest. Those anchors give Chinese crushers flexibility, even if U.S. tonnage surges through early year slots. Competitiveness depends on more than headline demand. ERS data depict production expenses plateauing at a high nominal level. Interest expense and labor remain structural line items that require productivity gains or policy offsets. If tariffs keep traded inputs dear, machinery, chemicals, components, margins stay tight even when volume commitments rise. Those are balance sheet facts, not narratives. The employment backdrop complicates price transmission. Reuters marked August payroll growth as weak with unemployment at 4.3%, a 4-year high, while the BLS long-term share ticked up, a combination that historically correlates with discretionary spending caution and pressure on retail pricing power. Those dynamics feed back into tariff-sensitive categories. Observers parsing the deal frame it as a managed pause rather than a settlement. Reuters' list from Busan stressed that enforcement specifics and reversibility remain open. China's commitments to soy, sorghum, and hardwood logs are quantified. The United States' commitments on export control scope and port fees are time-boxed. Rare earth licensing is paused, not dismantled. That architecture invites re-escalation if either side judges the other's implementation as lacking. A separate policy front confirms the legal ceiling on rollback. As litigation swirled around executive authority on tariffs, Reuters reported November 4th that officials argued the Supreme Court cannot unwind the full tariff stack, signaling that large portions of the duty regime will persist absent explicit executive action or legislative change. That reduces the probability of a swift return to pre-trade war baseline rates. On the metal side, price and volume indicators will register any slippage in enforcement. Reuters' mid-October coverage tied equity moves in the rare earth complex to China's licensing stance. A durable pause could soften near-term tightness, but IEA's structure charts still imply an overwhelming upstream-midstream advantage for China that cannot be neutralized within a single year. Industrial planners note that magnets, not ore, are the binding constraint in electric vehicle and drone supply chains. For agriculture, the near-term watch points are USDA's November WUSDE and ERS updates. ERS on September 3rd projected 2025 production expenses at $467.4 billion, and average farm business net cash income around $127,000, with the latter supported by government payments as well as receipts. A mix that cushions volatility but does not resolve cost structure. The WASDE will refine yield and export assumptions that determine whether the soybean commitments relieve stocks or merely reshuffle origin. Monetary policy is the parallel hinge. Bloomberg quoted Powell saying another cut in December is far from assured, even as the Fed ends Treasury runoff December 1st. Reuters' companion note specified the mechanical change to reinvestments and the move of MBS runoff proceeds into bills. The stance lowers funding friction without committing to net asset growth, but it creates optionality for balance sheet expansion in a stress event. The operational synthesis is straightforward. The Busan package trades a one-year reprieve in export controls and a tariff trim for quantified commodity purchases and cooperation pledges. The Fed trades a small rate cut and an end to runoff for breathing room in money markets. China and the United States trade inventory windows to shore up strategic materials. All three trades price time, not resolution. One data point will decide whether reprieve reads as reset. If China's soybean commitments translate into sustained U.S. loadings while Brazil still delivers record crops, Gulf bases can improve without eroding Brazil's dominance. If rare earth license pauses translate into steady magnet exports, even as domestic Chinese policy tightens later, the supply chain breathes. If the Fed's reinvest-only posture stabilizes funding costs while unemployment edges higher, further policy action returns to the table. The next prints, NEC loadouts, Chinese customs on magnets, BLS on long-term unemployment, will tell the story. The risk case is equally specific. China's share of magnet-grade capacity remains so large that any snapback in licensing would bite immediately. Tariff relief is partial and time-limited. ERS shows farm expenses still elevated, and the Fed has signaled caution about December even as it removes a significant drain on reserves. The structure of those facts forces a question without decoration. When the one-year clock runs out in Busan, does anyone still want to buy time at the same price? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.